While you were scrolling headlines this weekend, a silent transfer of power was already in motion, not in Congress, not on Wall Street trading floors you can see, but inside balance sheets that decide how expensive your life will be next year. At midnight policy briefings, a 10% cap on credit card interest was floated. $200 billion in mortgage bonds were ordered into circulation, and large institutional buyers were quietly warned to step away from single-family homes, not tomorrow, not next year, but now, before markets reopen, before pricing models catch up, before your bank app updates. This wasn't about affordability in the way it was sold on television. It was about leverage, who controls credit spreads, who absorbs risk, and who gets first access to cheaper money. BlackRock doesn't watch press conferences. JP Morgan doesn't wait for legislation. They read signals. They reposition capital within hours. Lower rates sound like relief, but rate suppression always has a counterparty. Someone pays, someone benefits, and it's rarely the retail borrower first, because when $200 billion moves before Monday morning, your mortgage, your credit card, and your retirement fund are already part of the trade, and nobody is talking about what it actually means for your wallet. What you're watching isn't policy, it's software, an economic operating system that has been deployed repeatedly, refined through decades of crises, debt cycles, and emergency interventions. The code always runs in 4 stages, clean, efficient, and invisible to anyone focused only on speeches instead of spreadsheets. Stage 1, financial isolation. Credit is redefined before it's repriced, caps are floated, spreads are compressed, and access becomes selective. Not everyone gets cheaper money, only borrowers that fit newly rewritten risk models. While banks quietly reshuffle portfolios away from high-yield consumer debt. Stage 2, narrative control. Affordability becomes the headline, relief becomes the justification, and intervention becomes morally untouchable, because opposing it sounds like opposing households, not questioning who absorbs the losses. Stage 3, strategic intervention. This is where the machinery hums. $200 billion in mortgage-backed securities aren't purchased to help sentiment. They're deployed to collapse spreads, stabilize MBS pricing, and reopen the refinancing pipeline for institutions already positioned long duration. Stage 4, resource allocation. Not extraction of oil or gold, but of yield, housing stock, and retirement inflows, as restrictions on institutional home buyers quietly reshape supply while capital rotates into adjacent vehicles, REITs, private credit funds, government-backed instruments with implicit guarantees. Each stage looks disconnected on the surface, but together they form a closed loop. Volatility creates permission. Permission creates policy. Policy redirects money. Stage complete. System online. To understand why this system works so well, you have to step outside the headlines and into the archives, where the same financial operating system was deployed long before housing affordability or credit card caps ever entered the conversation. Case 1, Iraq, oil, and the currency switch. In 2000, Saddam Hussein made a decision that barely registered with the public, but triggered alarms across global finance. Iraq would begin selling oil in euros instead of US dollars. A symbolic move on television, but a structural threat underneath, because oil priced outside the dollar weakens demand for US debt, and demand for US debt is what keeps American borrowing cheap. Stage 1 arrived quietly. Iraqi assets were isolated. Banking channels narrowed, and trade became increasingly restricted. Liquidity dried up before anything else did. Stage 2 followed. The narrative hardened. Compliance, security, stability, words that create moral permission without mentioning currency flows. Stage 3 was decisive. The regime collapsed in weeks, not years. Leadership disappeared from the system, and control of policy vanished with it. Then stage 4, contracts, not chaos. Within months, ExxonMobil, Chevron, BP, and Shell were positioned for access to some of the world's largest proven reserves, over 143 billion barrels of oil. now flowing back into dollar-based settlement structures. Case 2, Libya gold and the unacceptable alternative. Libya wasn't about oil alone, it was about money that couldn't be printed. Muammar Gaddafi was sitting on 143 tons of gold and pushing a pan-African gold-backed dinar to bypass both the dollar and the euro. Stage 1 isolated Libyan banking access. Stage 2 reframed intervention as protection. Stage 3 erased centralized control faster than markets could price it in. And Stage 4 arrived silently. Libya's gold vanished from the equation, energy contracts fractured, and Western-aligned firms moved into the vacuum. No gore, no spectacle, just balance sheets realigned and alternatives removed. History doesn't repeat itself loudly, it repeats efficiently. Now rewind back to the present, because the same operating system is running again. Only this time, it's not deployed overseas, it's being executed inside the American household balance sheet. Stage 1 is already live. A proposed 10% cap on credit card interest doesn't isolate banks, it isolates risk. High-yield consumer debt becomes unattractive overnight, forcing lenders to quietly retreat from subprime exposure, while prime borrowers are funneled into newly branded voluntary products. Stage 2 is on every screen. Affordability dominates the narrative. Relief is framed as urgent, and questioning the mechanics sounds like opposing families trying to buy groceries or homes. Stage 3 is where the real signal appears. $200 billion in agency mortgage-backed securities purchases compress spreads without touching the Fed's balance sheet, a workaround that institutional desks understand instantly. Duration trades light up, refinancing models are dusted off, and liquidity returns to markets that froze under high rates. Watch the waivers, not the speeches. Energy and housing lobbyists don't fight these moves, they adjust to them. Capital shifts toward government-backed yield, while defense and infrastructure equities quietly outperform on expectation of sustained policy intervention. Stage 4 hasn't been announced yet, but it's visible. Restrictions on large institutional buyers don't remove them from housing, they reroute them into build-to-rent, private credit, and long-duration asset vehicles that retail investors rarely access. Peace isn't written into press releases. It's written into 99-year contracts and balance sheet exemptions. Here's where the system finally reaches you, not as a headline, but as a monthly statement. Lower credit card rates sound like relief until banks respond the only way they can, by tightening access. Limits shrink, approvals slow, rewards disappear, and the people who need flexibility the most are quietly filtered out. Volatility doesn't vanish, it's redirected. Mortgage rates may soften, but prices don't fall the same way because supply doesn't reset overnight. Cheaper money revives demand faster than it builds homes, pushing prices higher even as rates dip. Affordability improves on paper while total debt quietly expands. Then there's your retirement. Allowing 401k withdrawals for down payments sounds empowering, but it converts long-term compounding into short-term liquidity. Your future yield becomes collateral for today's housing market. And while institutions arbitrage decades, households absorb timing risk, energy stocks stabilize, defense and infrastructure funds outperform, and large asset managers collect fees on both sides of the trade. Active volatility is profitable, stable wages are not. Inflation doesn't need to spike to transfer wealth, it just needs to persist, quietly eroding purchasing power while asset prices stay elevated. They win by navigating cycles, you lose by living inside them. Because this system doesn't break households overnight, it drains them slowly, invisibly, one policy at a time. This is the part they never put in the briefing, the part that doesn't fit inside a talking point or a ticker symbol. The pattern doesn't care who's in office, it doesn't vote, it doesn't campaign, it simply activates when volatility creates permission. And once it's running, the transfer is already underway. You can't stop it with outrage, you can't slow it with hope, because the system feeds on both. It converts fear into liquidity and optimism into leverage. While institutions position years ahead of the headlines, the wealth transfer isn't announced, it's executed quietly, legally, and repeatedly through rate caps, asset purchases, and narratives designed to keep attention away from balance sheets. But awareness changes timing, and timing is the only edge left. If you see the stages early, you don't panic at stage 3. You prepare at stage 1. You reduce exposure to shrinking credit. You question free money, and you protect compounding instead of spending it. The pattern creates the wealth transfer. You can't stop it, but you can see it coming. Subscribe if you want to stay ahead of the money before the next stage goes live.